This conundrum as well, because people aren't necessarily jumping to list their homes or add that inventory to the market, knowing that there might not be prospective buyers out there right now because of the rising rate environment.
100%. I mean, inventory levels, keeping a cap on inventory levels is going to be the saving grace of the housing market, no doubt. So the data that we saw last week, the data that's coming out this week, existing home sales, pending home sales, inventories, units under construction, etc. All of that is lining up and stacking up for overall, again, like a tempering in the housing market. But the numbers coming out don't really matter at this point, right? Who cares about August and September when October, again, mortgage rates increased up through 7%. And monthly mortgage payments are now above 60% increase just from 1 year ago.
Carly, when we do get the sense of that Fed pivot, how does that change how you put money to work?
The sense of the Fed pivot, if they start to temper back their rate hikes, what happens, I think, is that the U.S. is really strongly positioned right now to have a foothold in the global economy. So we took a much more hawkish stance on our central bank policy, and what that's resulted in is this currency destabilization across major markets throughout the world. And I think given that the U.S. is really able to export energy, we can supply our own food, we can supply our own manufacturing. We are the second largest manufacturer globally. That's setting up the United States to be well positioned to come out of whatever cycle we are going to see over the next 12 months. So as a real estate investor, I would definitely focus on the U.S. and I would focus on more non-cyclical, inflation-linked assets such as housing, industrial, healthcare, related assets, etc.
Is home builder confidence from what you're tracking, is that starting to improve or show any signs of alleviation from the declines that we had seen? Because delivering a house fully at this point, given some of the logistics and supply chain challenges, that has been cited, that's been noteworthy and impacted that confidence.
Yeah, absolutely not. Absolutely not. I do not expect home builder confidence to come back anytime soon. As you saw, it's plummeted and it's expected to continue to plummet. What that will result in for investors like us is an opportunity actually to scoop up some new inventory and master plan communities at, I think, prices that will be well below what we could have seen last year.
How long after the Fed sees what it needs to on the housing side and home ownership side, do you believe that it will take for actual rental prices to start to come down?
I think rental prices are going to start to come down. So if you just look at certain simplistic stats, right, like home prices to wages, that index is well above a normalized mean. That is not a good indicator. I think that leads to a softening in rents. Also, if you look at just inflation numbers, particularly core CPI, shelter accounts for 40%, so an increase in shelter costs. So there is going to be continued pressure to get those prices down, particularly in the rental market and the home market. But I would say that if you look across your rental options, single-family rental, we're really seeing a lot of tempering in new starts and under construction versus multifamily, which is continuing to outdo historical numbers.
Nuveen Real Estate Global Chief Investment Officer Carly Tripp, thanks so much for joining us this morning.
Thank you.
And everyone, coming up, Saz is going to break down some bizarre trends from company earnings reports. That is next. Welcome back to Yahoo Finance Live this morning, everyone. We're taking a look at the major averages here in the U.S. The Dow is up by more than 400 points, about 18 minutes into trade here on this Monday, and we're seeing gains of about 1.4, 1.5%. We'll round that off to S&P 500. You're also seeing that move higher by about 1% right now. Utilities was one of the major leaders earlier. We'll continue to track in on that later on. Consumer discretionary was bringing up the roof. Keep a close eye on the sectors and that activity for you. But also, let's take a look at technology, the tech-heavy NASDAQ. That right now flat just barely to the upside right now. So tech not fully in on the positive gains party, if you will, at the gate. But the other two major averages are well, everyone, it's been a volatile year for the markets as record high inflation and rising interest rates have sent the U.S. equities on the roller coaster ride. Said they're waiting for the bell time. Okay, that's where we find the stake today. Stop.
Hey, how's it going? Yeah, look, this is coming off the Yahoo Finance Morning Brief on our homepage right now. Just looking at a lot of the, I would say, confusing signals that investors are getting hit over the head with. First up, as I mentioned in the newsletter, you have Bank of America CEO telling us consumer spending up 10% through October. Good. American Express CEO telling us that he's not seeing any signs of recession. He's in the business. Meanwhile, you have Snap stock last week and absolutely pummeled because of an ad market slowdown. You have to think, well, that is probably going to show up in the output results when they report as well. Generac, talked about Generac last week. Too many generators in the channel. People are not buying these things. Whirlpool, a company known for its execution, comes out last week, slashes its guidance. Verizon, you talked to CEO Hans Vesper last week. Brad, I would think something more cautious tone in the business. As a result, Verizon this morning, I think, was downgraded. AT&T upgraded after their quarters. And, you know, I go into this a little bit more in the newsletter. It's going to be hard, I think, for investors to truly gauge what's happening out there in the market or what will happen next until a couple of key things happen. And this comes compliments of UBS Chief Investment Officer Mark Heckley, noting that the U.S. inflation and labor market data do suggest that interest rate cuts being far off. We do get rate cuts. That is historically proven to be a very good thing for markets. Also, Mark mentions that consensus earnings forecasts probably have not come down enough to account for tighter monetary policy. And the last two, and along those lines, valuations, yeah, they've come down a lot off the highs from last year, but still, relative to history, they remain elevated given where we are in the interest rate cycle. So there's a lot coming at investors, and my take is these are very weird times. And I think I've used this take before, probably like 5, 6, maybe 10 times. There's just a lot of weird things right now happening in these markets. Supply chain inflation, you have companies warning, you've got credit card companies telling us spending is strong. And it's tough to be an investor. It's always tough. But right now, I think it's one of the best
already show up in snaps and where they're full guidance. And so within where we're moving forward and some of the major themes that we're seeing, if we zero in specifically on tech for a moment, it's really as a result of where consumers spending their time, how valuable that time is to the advertisers that are going to be trying to get that top of funnel in there, and the conversion rates at the other side of that funnel too. And so for the companies that we're going to hear from over the course of this week, there's the advertising business. There's also the major kind of pullback in spending that a lot of companies are using at this point in time. I mean, we're going to talk in a moment about some of the job cuts that are also still being put forward at some major technology companies. And within those cuts, there's also pullbacks in spending on some of the applications that companies use. Do they need to spend further into data centers or into clouds right now? The price is not good, but it's just this question of where will that actually start to accelerate so much so that it needs some of the most major tech companies to actually decrease their guidance, or even some of them you might see pull because of the uncertainty.
And that is the other weird aspect. This is a bonus weird thing here. Investors have been trained, I think, that they can hide out in big cap stacks. So Alphabet, Microsoft, Amazon, those trades have worked absolutely amazingly over the past decade. But now, to your point, all of these companies are seeing slowing growth at a time where their valuations are still high. And that is a big shift in the investment environment that investors, I think, are still very much in.
Track all of this, of course. Earnings season just keeps up. It is on the front burner, everyone. Coming up on the other side of this break, why our next guest says energy remains the political and political and worldwide. That's next.
count your eyelashes secretly, pretend that we were meant to be, but the light went out and there's no one home. I count the lines around your smile, hold the thought for a little while, but the light went out and there's no one home. No one home. No one home. No one home. I count your eyelashes secretly, pretend that we were meant to be, but the light went out and there's no one home. I count the lines around your smile, hold the thought for a little while, but the light went out and there's no one home. No one home. Just before dawn comes, sadness is on. Just one more moment and I am leaving.
Welcome back to Yahoo Finance. I'm Brian Sazi alongside Brad Smith. Julie Hyman has the day off. Markets are trying to shake off some mixed economic numbers out of China that have put pressures on shares of Alibaba and many others. And so far, they are doing just that, shaking off that negative news. You're seeing the Dow up more than 400 points to kick off this trading week. Here's what else we have on tap this hour. Social media wreckage. We'll chat with one analyst to see if there are any bargains to be had in the beat-up social media sector. And a not-so-electric take, a Harley-Davidson EV spin-off gets a cautious take by the team over at Citigroup. And Beyond Beef, struggling Beyond Meat, is pushing forward with a key new product this week after revealing recently a wave of layoffs. Brad, over to you.
All right, taking a look at the major averages as we are 30 minutes into today's trading session almost at this point. We are seeing the Dow Jones Industrial Average still holding on to gains. And here's what I wanted to put in context for you. This past 5-day move, we're still holding up by about 2.4% there with today's add-on of about 1.25%. NASDAQ Composite Tech Heavy Average struggling to get into the same type of move that we've seen for the Dow and the S&P 500, but still up on the day, holding on to gains of about 0.2%. Intraday here, we did see some early waffling out of the gate. Yeah, that's your W to give you that waffling oscillation action. But also the S&P 500, you're seeing that up by about 1% right now. No testing of that flat line. It has just been up in the green, off to the races here. Also, speaking of off into the races, we are off into the races with earnings season. As of right now, we've got big tech coming out this week. We've also got, in the autos landscape, Ford and GM. That's set to come out. Of course, Tesla, last week we broke that down for you. But taking a look at Ford, here on the day, it's up by about 2.5% to kick off the week. Also taking a look at GM, you're seeing that up by about 1.5%. So GM, they're going to be reporting on Tuesday. Ford, that's going to come on Wednesday as well. And so those two companies certainly going to be in focus. GM stumbled out of the gate this morning, was negative for a moment, but now settling in positive territory, up by about 1.5%. And then also just taking a look at some of the other autos here as well. You've got Rivian, that's actually down by about 3% this morning. Keep a close eye on RIVN. And then lastly here, Lucid, NIO. You're seeing NIO down by 17%, excuse me. And so keep a close eye on NIO as well as we move into that rest of the trading session. Let's look at some of those EV names, but let's turn now to energy markets. Energy and crude are
a political hand grenade for nearly every country, this according to our next guest. OPEC's relationship with the U.S. and the U.S.'s use of the Strategic Petroleum Reserve is just one of several flashpoints worldwide. With more, we've got Rebecca Bassett, who is the senior energy trader over at CIBC Private Wealth US. All right, help us break this down a little bit more. When you say political hand grenade, what should we expect to play out with regards to this?
So that's a great question. I think what we should expect to play out is a lot of volatility going forward, right? We're looking at an escalation of relationship in the U.S. and both parties trying to influence how crude trades, one by cutting production and supporting prices, and the other by releasing barrels of the SPR into the market, right? So you have these dueling factions, both trying to sway market pricing. This is a big deal because this is a market that traditionally trades on fundamentals, supply and demand, and now you have these two huge players kind of at the other end of the polls trying to influence the market. So that's one thing to expect. I expect that we will see more SPR releases come throughout the winter. Last week's announcement from Biden really was a reiteration of what he's already deployed, which was 180 million barrels in May. He said he's going to do the last 15 million barrels over the next month. There is room, however, for him to do more as we head into 2023, and I do expect that. On the other side of that equation, I think we have OPEC Plus, which is going to continue to cut production and make sure that the market does not feel a lot of downward pressure. Why are they going to do this? Because the macro environment is super challenging right now with cross currents. Chinese demand is a huge concern, European recession is a huge concern, and they really want to support prices in the near term and not let the bottom fall out of crude as it has done in previous cycles.
And Rebecca, given those you have OPEC Plus cutting, you have the Biden administration putting more oil out there on the market, what does that mean for prices?
It's a great question, and a lot of that hinges on what happens as we head into the December 5th EU sanctions package and how much Russian crude is disrupted based on those sanctions. So I personally think the market is anticipating about 1 million barrels of Russian crude to be disrupted due to the increased sanctions, and that ultimately the floor under crude is strong enough to hold, but the upside is a little bit more of the unknown. If we lose 1 million barrels of Russian crude and China demand starts to improve, and I know the data we saw today wasn't really indicative of that, but if it does, you could see a lot more upside. So I think ultimately you have downside kind of to that 70 to 75 range, and you have upside north of 100. So if you're looking at risk reward, it really feels like at this point we're fairly well balanced, but the upside tail looks a little bit more explosive. However, there are very few investors willing to put that money to work. Look at positioning that came out over last week. We saw continued cutting of WTI, Brent, and gasoline products positioning as the market is really afraid of all of these risks and not really feeling comfortable making a bet either way. So I think that's what increases the volatility, is the lack of positioning and this really outside scale of either end of the spectrum.
Is China still comfortably a purchaser of Russian oil supply?
I think they do. So I think that it makes a lot of sense for them. And if you just look at their most recent actions, they're increasing their imports of crude, even though their demand for crude isn't increasing. Why? Because they've increased their quota for export of product. So they're buying cheaper crude from Russia, they're increasing their refining capacity, and they're selling that really expensive product out to the market. As we have all talked about, refining markets have been really robust, and they're able to turn that profit. It makes sense for them on a multitude of levels. It helps spark internal demand and keep the economy going a little bit. It fills a hole of the product supply that could be disrupted from Russia, and they're able to turn a profit. So I do think they're going to continue to want Russian crude. I don't think they're going to be super public about it, but I think they'll continue to buy it.
Rebecca, we've seen some reports recently that looking at the heating oil market this winter, U.S. consumers, they might see the bills go up anywhere from 20 to 30%. Does that sound about right?
Yeah, it does. And it's unfortunate, but the reality is our heating oil inventories are very low. I mean, the lowest I think that they've ever been. Does it mean that we're going to have run out of inventories? No. It means that we're going to have the potential for spikes, particularly in a cold winter. And I think it's drawing a lot of concern. And that's why we're seeing China really ramp up their diesel exports because those refining margins are so high for diesel. The U.S. is in this situation because we've cut a lot of our refining capacity. So even though we have a lot of crude coming out of the ground, we don't necessarily have the refiners there to produce a product to help kind of meet these needs. So unfortunately, 20 to 25%, I think it's kind of where prices are looking. If we get a mild winter, that could come in. But it's really kind of a weather-dependent scenario, and I think there's a lot of fear baked into that as well.
Rebecca, I'm going to ask a question that is absolutely fueled by my own personal aspirations of seeing lower airline prices in the future, and where in this environment they're purchasing from the different suppliers and refineries, and particularly where that will actually net out for them to see lower fuel costs. We saw it show up in American Airlines earnings that they were paying 97% higher for some of their supply. And so when will that start to subside for the airlines and their purchasing requirements that they need just to operate their routes?
I don't think that subsides in the next 6 months or even maybe the next year, unfortunately, unless, and this would be the sad scenario, we have more restrictive travel policies globally due to COVID. But based on where things are right now, the demand stays where it's at, and I kind of feel like it might. You don't really see that pullback in jet because, again, you need someone to refine all that crude into jet fuel. And right now, it's more attractive to refine it into diesel because that has the higher refining margin. So you're going to use all your refinery capacity for diesel, and then you'll do jet, right? Until the price of jet becomes so expensive that people reconfigure their refiners to sell jet. So the sad answer is probably not for a little while. You might see a modest dip, but I don't think you go back to kind of really, really attractive pricing for at least a year.
Rebecca, I just purchased 5 new blankets for Target because I'm not hitting my thermostat this winter. Not touching it. It might be 60 degrees in my face, just not going near it. Rebecca Baron, senior energy trader at CIBC Private Wealth. Always good to see you. Talk to you soon. Analyst coverage on Harley-Davidson EV spin-off LiveWire is trickling in following the brand's IPO in late September. City analyst Matej McCallie initiated coverage on LiveWire today with a neutral/high-risk rating on an $8.70 price target. Said McCallie, despite a favorable long-term adoption outlook, there are some differences versus the EV passenger car market that could present challenges such as regulations, subsidies, demographics, and licensing. McCallie adds to the analysis of LiveWire's web traffic is not showing clear momentum for the brand just yet. Coming up, Toshiba could be on the verge of getting a new owner. Brad is back with that and today's top headlines next.
Philips is cutting 4,000 jobs immediately after a bigger than expected loss Monday. In a letter to shareholders, the CEO said that Philips faces multiple challenges and its earnings reflect that. He went on to say the cuts will improve productivity and stability. The company reported a net loss of over €1 billion, largely due to the supply chain issues and a mass recall in breathing machines. Now, another superhero flick brought in big numbers for the weekend box office. DC's Black Adam tallied $67 million domestically, and that was during opening weekend alone. It's the first film since Thor: Love and Thunder to cross the $50 million mark at the box office. And Pinterest is partnering with mental wellness app Headspace to offer mental health resources to content creators. Though through the partnership, the creators, they're going to get this free 6-month subscription to Headspace. Pinterest saying this is an effort aimed at supporting creators by integrating well-being practices into their everyday lives. Eligible creators must be regular contributors to original content, publishing 3 or more pins over the last 3 months. And a group led by Japanese industrial partners is considering a takeover of Toshiba. The group evaluates the company and values the company at about 2.4 trillion yen, marking what could be Asia's biggest buyout this year. That's according to Bloomberg. Toshiba has reportedly asked banks for financing support for the deal. Shares of Toshiba are up around 14% year to date. Saz?
Global markets have been watching the situation in China closely as President Xi consolidates power and enters an unprecedented third term as leader of the country. The move making many uneasy as U.S. and China relations are already strained. Last week, Yahoo Finance's editor-in-chief Andy Silver sat down with economist Nouriel Roubini during the All-Market Summit to discuss the state of U.S.-China relations, and Andy joins us now. Andy, Dr. Doom, always good to catch up with him.
Yeah, Dr. Doom, Nouriel Roubini, saying that we're already in a third Cold War with China, so not very good for the sensibility there or the markets. But, you know, when you're talking about Xi Jinping consolidating power, Brian, over the last week, it really, you know, wasn't a surprise, but I think the particulars surprised people, how he did it. I mean, if you saw, for instance, the footage of the former president, Hu Jintao, being removed forcibly from those meetings, it was really chilling. I mean, look at this stuff, but, you know, and this is all for show because this didn't have to be done. I mean, what a humiliation for the former president. And you see Xi Jinping just sitting there. Some people were saying, you know, that, well, Hu Jintao was not well and needed to be removed, but, you know, this didn't have to be done publicly like that, I think. You know, there's a number of things going on in China, and I think that, you know, the peaceful transition of power in this authoritarian regime has been something that has actually really been kind of remarkable for China since Mao Zedong, and now you've got a situation where instead of 2 terms, it's 3 terms. That's unsettling. A couple other points, you guys, that are also unsettling. One, using the zero-tolerance COVID policy to turn the country more into a surveillance state, number one. Number two, also reducing corruption and trying to address wealth inequality, but also using that as an opportunity to remove political opponents is something else that Xi Jinping has done. And if you look and see how the markets in China, the Hang Seng, have responded, you know, that is not a pretty picture. And my understanding is that's the worst drop since, 2007, 2008. So, you know, Stan Druckenmiller was talking the other day, you need to look forward 18 months, 24 months out. What does it look like? This situation is not going to be a great situation, I think, for tech stocks, for Chinese stocks, for companies that have big exposure there. So it's unsettling and unnerving.
There's still so much that is unresolved on the kind of tit-for-tat trade war that took place back during the Trump administration. And so even now, with this move in China, what does that signal for the Biden administration in terms of the broader kind of business component here in rectifying some of those issues that still are unresolved?
Well, Brad, you know, it's not like President Biden has reduced those tariffs, right? And in fact, you know, he's imposed measures that are arguably more harsh when it comes to the tech sector and chips. And you can understand that because when you're talking about surveillance, this is a real risk to the U.S. economy and to the global economy. You know, on the other hand, it's not doing anything to increase trade and, you know, kind of alleviate tension. And then, of course, hanging out across the horizon there is Taiwan and the situation there and how that is going to be resolved. That is something that is very much front and center on Xi Jinping's agenda. And how that transpires, if and when China ever reclaims that island nation as part of China per se is going to be a very, very touchy thing going forward. I'm not telling you guys anything you don't know, but I guess the bottom line is things are not really getting better. And what's really interesting, and back to your original point, Brad, is Republican president, Democratic president, continuity, right? Same thing, and so that's tough for relations there.
Hey, that footage at the top, wow, that was just jarring.
Yeah, it's shocking. And, you know, again, people are saying, oh, he wasn't well. Well, you know, they could have just said, we're going to take a pause here, turn the camera off. That was when Westerners were there. Chinese media not reporting on that, but the footage is out all over the place. So in other words, the Chinese leadership wanted this footage out there. They don't want to comment on it. And, you know, look at this, it's just
Almost no acknowledgement.
No, right. Look at this, look at that body language right there.
Yeah. Wow.
Yeah.
Unreal. Wow. All right, we'll leave it there for right now. Yahoo Finance Editor-in-Chief, Andy, sir, always good to see you.
Thank you.
Appreciate it.
Yep.
All right, sifting through the social media stock wreckage. More on that straight ahead. Snap's ugly earnings report has sent fresh shockwaves throughout a social media landscape struggling with slowing growth, bloated costs, and weak stock prices. So what's the next shoe to drop here? Rete Research senior analyst Rocco Strauss joins us now to discuss. Rocco, good to see you this morning. Is it time to start picking at the rubble here, or you just stay away from the space?
I guess with respect to Snap, I mean, there still remains to be an unfavorable advertising mix for them, with Snap being sort of overly dependent on discretionary spend. You know, when you think about like the VC-backed grocery and crypto app installs, you know, budgets vanishing in the last quarter or so, there's still an overhang from Apple's ATT or the IDFA issue weighing on gaming budgets. And Snap is now also seeing brand budgets moving to the sidelines, which is probably like a macro headwind that they're flagging. So your best proxy is probably looking back to 08, 09, where 2008 was still a fine year for ad agencies and a lot of brand spend. And then 09, so a year after literally Meta and other things hit, you saw like a minus 10% or so hit on top line on these guys. So back to Snap, I would still say that against, like TikTok and other social media networks, there is a lot of utility on the platform, especially with messaging. There's a lot of first-party data that they have. And there are also like a few under-monetized ventures like Maps and Spotlight, building AR features, in an e-commerce environment and so on. And that actually makes us slightly positive on the prospects of Snap if they continue to invest through this recessionary environment.
Is there a turnover in favorability of social media platforms? And if so, which ones are slated to continue to win kind of the screen wars and that attention for time, which directly correlates back into where and why advertisers would want to spend their dollars on these platforms?
Right. I guess what you have seen now on Spotlight, on Snap, you could talk about YouTube Shorts, you could talk about Reels on Instagram. All these are kind of Me Too offerings to what TikTok is doing. And the question that we would raise is, moving forward, maybe a year from now, are we talking about TikTok stealing time away from these properties, or are we having more utility alongside these other Me Too offerings that keeps people on the, more established social media networks? It's hard to say where user adoption is going to go to, but there's a huge risk for TikTok now, not the other way around.
Well, then how does Snap go about restoring investor confidence?
Yeah, it's as what I had pointed out, it is really kind of like changing this advertiser mix, like going more into DR, especially e-commerce related offerings. There's an integration with Shopify. There are others like that out there. That's what you have to prove, and you have to start monetizing these ventures where you're not seeing ads right now, especially Spotlight, which will draw some of these TikTok budgets. Think about like also other video budgets coming live with respect to Netflix and Disney Plus and so on, which will draw a lot of the linear TV budgets over into digital, and they are likely also going to end up in some of these social media networks.
All of the social media networks right now are trying to become the shopping mall, or at least replace the need for going to physical retail and drive more conversion. Can they successfully fill the void where perhaps that in-person shopping experience can be offset by that virtual shopping experience driven by interest and then actual purchase decisions? And do you see that actual amount of money that's going to be spent on these platforms improving over the near term as well?
Yeah, I guess it's a few things that need to happen, right? First, it is we have to work on friction between looking at products, buying them, after sales service with respect to messaging integrations and so on. And these platforms are working on that. You see that with click-to-messaging functionality on WhatsApp, like in the Meta universe, and we are going to see more of that. The second thing that we need to see is more integration of inventory. So literally every one of these social media platforms has integrated with Shopify. There are many more similar offerings like Shopify out there. If you think about like a WooCommerce, for example, and so on. These need to happen and need to be smooth as well. You have to think about like combined baskets so that a checkout experience, might work significantly easier than it is today. And then lastly, when you also think about all these ID headwinds that we're having, and Apple's ATT is just the beginning, right? You have to think about like SDK runtime on Android. You have to think about cookies disappearing. For many of these retailers, both omnichannel and smaller D2C brands, it is becoming significantly harder to track from an ad to a conversion if there is not an on-platform checkout functionality embedded into that. So the more we are going towards in that direction of IDs disappearing, the more likely we're going to see adoption of these on-platform functionalities, and that should increase the shopping that we're seeing in these platforms.
Okay, and so with so much of that focus on shopping being either prompted by the consumer data that the companies, the social media platforms are looking at, or just by the trends of how many people are just comfortable spending their money on a social media platform, does that mean that there's an authenticity vacuum with legacy social media right now? If everybody's just trying to sell me on something, and content creators, I know that they're in partnership with someone who wants to get my dollar at the end of the day, then where do I go to actually just have that valuable connection?
Yeah,
Yeah, I mean, if you think about some of the larger retailers out there, right? So name Amazon, name Etsy, name eBay. All of these have an issue that they don't really have any social media connections or offerings on the side. Amazon might be with Twitch, but it's still small compared to these other social media networks. But what all of them have, and throw Shopify in the bucket as well, is they have huge audiences and they have huge intent and conversion data. And if these data, if that sort of data can be made actionable into these social media environments, and that brings us, like also into the discussion of clean rooms and privacy laws and so on. But if that data can be made actionable, then we're not going to be overloaded with shopping-related ads. It's going to be likely significantly more targeted than we have seen it so far.
Okay, all right. Perhaps just my own chagrin that I inserted there into the conversation. RateTech Research Senior Analyst Rocco Strauss, we appreciate your analysis of all these companies and breaking that down for us this morning. Thanks. Coming up, big tech earnings are on tap this week. But what does this mean for ETF investors? We've got that conversation for you next. All eyes are on big tech this week with Apple, Amazon, and Meta, plus Alphabet, all set to report earnings. But how will this impact ETF investors? VettaFi head of research Todd Rosenbluth joins us now to discuss. Okay, so help us break this down. I mean, with regard to some of the ETF trends that we've seen thus far, what are inflows looking like into tech sector ETFs?
Well, the technology sector has been relatively strong in 2022. We've seen over $6 billion of money go into technology ETFs. That's following on with some of the more defensive sectors. So we've seen strong inflows into consumer staples, strong inflows into utilities. Healthcare has actually been the leading sector, whereas consumer discretionary and communication services sectors have seen net outflows. And as we tie into the big tech earnings that you talked about, it really matters what ETF we're talking about and how it's classified.
Todd, where do you see investors gravitating to more specifically in the tech? Are they still staying clear of anything that owns a social media stock?
I think what the real focus for them is understanding what is inside these portfolios. So we mentioned earlier Meta and Alphabet are reporting results. Those are classified as communication services companies in many of the sector ETFs. So you would find that in XLC, which is the Communication Services Select Sector Spider ETF, but you would not find Meta or Alphabet within the Technology Select Sector Spider, which is XLK, or the Vanguard Information Technology ETF, VGT, because these sector ETFs are tied to the GICS sector framework, and S&P and MSCI classify companies like Apple and Microsoft as technology companies, like Meta and Alphabet as communication services companies. And so the devil is in the details as to what's inside these portfolios.
So with regard to all of these big tech names, it's still going to come down to what their free cash flow looks like and where they're maintaining margins within their businesses. Some of them very much advertising focused, or all of their businesses advertising, whereas some of them have a little bit more at play with regard to Amazon there. And so what would you be watching kind of throughout these tech earnings to see where they're maintaining some of those margins?
So I think the focus for all of these companies, we're likely to see the currency headwinds happen. All of these companies are multinational in nature. It's different how their exposure happens to be, but we've had a strong US dollar that is going to weigh down on overall profitability. It just comes down to how profitable they were before the currency impact. And so a company like Apple, which is again in the technology sector and part of VGT or XLK, the demand for iPhones is going to be important. A company like Meta, of course, it's tied to search. You're going to have different impact at search as well as social media. You're going to have a different impact as well. So I'm not an expert on individual companies, but I do think investors are looking to get exposure to these companies through the diversification benefits of an ETF, and they need to know what's inside those ETFs.
Todd, has anything surprised you this earnings season?
I think it's been better than we've seen and expected. I think financials has been relatively strong, and you get exposure to financials through the Financial Select Sector Spider ETF and through bank-oriented ETFs like the Spider S&P Bank ETF. I think that's been relatively strong. The bar tends to be set relatively low heading into earnings season, and